Part 5: Mergers and Acquisitions. Of all activities at Berkshire, the most exhilarating for Charlie and me is the acquisition of a business with excellent economic characteristics and a management that we like, trust, and admire. Such acquisitions are not easy to make, but we look for them constantly. In the search, we adopt the same attitude one might find appropriate in looking for a spouse. It pays to be active, interested, and open-minded, but it does not pay to be in a hurry. In the past, I've observed that many acquisition-hungry managers were apparently mesmerized by their childhood reading of the story of the frog-kissing princess. Remembering her success, they paid dearly for the right to kiss corporate toads, expecting wondrous transfigurations. Initially, disappointing results only deepened the desire to round up new toads. Fanaticism, said Santayana, consists of redoubling your effort when you've forgotten your aim. Ultimately, even the most optimistic manager must face reality, standing knee-deep in unresponsive toads. He then announces an enormous restructuring charge. In this corporate equivalent of a Head Start program, the CEO receives the education, but the stockholders pay the tuition. In my early days as a manager, I too dated a few toads. They were cheap dates. I've never been much of a sport, but my results matched those of acquirers who courted higher-priced toads. I kissed, and they croaked. After several failures of this type, I finally remembered some useful advice I once got from a golf pro, who, like all pros who have had anything to do with my game, wishes to remain anonymous. Said the pro, "Practice doesn't make perfect. Practice makes permanent." And thereafter, I revised my strategy and tried to buy good businesses at fair prices rather than fair businesses at good prices. A. Bad motives and high prices. As our history indicates, we are comfortable both with total ownership of businesses and with marketable securities representing small portions of businesses. We continually look for ways to employ large sums in each area. But we try to avoid small commitments. If something's not worth doing at all, it's not worth doing well. Indeed, the liquidity requirements of our insurance businesses mandate major investments in marketable securities. Our acquisition decisions will be aimed at maximizing real economic benefits, not at maximizing either managerial domain or reported numbers for accounting purposes. In the long run, management stressing accounting appearance over economic substance usually achieve little of either. Regardless of the impact upon immediately reportable earnings, we would rather buy 10% of wonderful business T at X per share than 100% of T at 2X per share. Most corporate managers prefer just the reverse and have no shortage of stated rationales for their behavior. However, we suspect three motivations, usually unspoken, to be singly or in combination the important ones in most high-premium takeovers. 1. Leaders, business or otherwise, seldom are deficient in animal spirits and often relish increased activity and challenge. At Berkshire, the corporate pulse never beats faster than when an acquisition is in prospect. 2. Most organizations, business or otherwise, measure themselves, are measured by others, and compensate their managers far more by the yardstick of size than by any other yardstick. Ask a Fortune 500 manager where his corporation stands on that famous list, and, invariably, the number responded will be from the list ranked by size of sales. He may well not even know where his corporation places on the list. Fortune just as faithfully compiles ranking the same 500 corporations by profitability. 3. Many managements apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they are certain their managerial kiss will do wonders for the profitability of Company T. Such optimism is essential. Absent that rosy view, why else should the shareholders of Company A want to own an interest in T at the 2x takeover cost rather than at the X market price they would pay if they made direct purchases of their own? In other words, investors can always buy toads at the going price for toads. If investors instead bankrolled princesses who wish to pay double for the right to kiss the toad, Those kisses had better pack some real dynamite. We observed many kisses, but very few miracles. Nevertheless, many managerial princesses remained serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. In fairness, we should acknowledge that some acquisition records have been dazzling. Two major categories stand out. The first involves companies that, through design or accident, have purchased only businesses that are particularly well adapted to an inflationary environment. Such flavored business must have two characteristics. One, an ability to increase prices rather easily, even when the product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And two, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. Managers of ordinary ability focusing solely on acquisition possibilities meeting these tests have achieved excellent results in recent decades. However, very few enterprises possess both characteristics, and competition to buy those that do has now become fierce to the point of being self-defeating. The second category involves the managerial superstars, those who can recognize that rare prince who is disguised as a toad, and who have managerial abilities that enable them to peel away the disguise. We salute such managers as Ben Heineman at Northwest Industries, Henry Singleton at Teledyne, Erwin Zaban at National Service Industries, and especially Tom Murphy at Capital Cities Communications, a real managerial twofer whose acquisitional efforts have been properly focused in Category 1, and whose operating talents also make him a leader in Category 2. From both direct and vicarious experience, we recognize the difficulty and rarity of these executives' achievements. So do they. These champions have made very few deals in recent years, and often have found repurchase of their own shares to be the most sensible employment of corporate capital. Your chairman, unfortunately, does not qualify for Category 2. And despite a reasonably good understanding of the economic factors compelling concentration in Category 1, our actual acquisition activity in that category has been sporadic and inadequate. Our preaching was better than our performance. We neglected the Noah principle. Predicting rain doesn't count. Building arcs does. We have tried occasionally to buy toads at bargain prices with results that have been chronicled in past reports. Clearly, our kisses fell flat. We have done well with a couple of princes, but they were princes when purchased. At least our kisses didn't turn them into toads. And finally, we have occasionally been quite successful in purchasing fractional interests in easily identifiable princes at toad-like prices. Berkshire and Blue Chip are considering merger in 1983. If it takes place, it will involve an exchange of stock based upon an identical valuation method applied to both companies. The one other significant issuance of shares by Berkshire, or its affiliated companies, that occurred during the present management tenure was in the 1978 merger of Berkshire with Diversified Retailing Company. Our share issuances follow a simple basic rule. We will not issue shares unless we receive as much intrinsic business value as we give. Such a policy might seem axiomatic. Why, you might ask, would anyone issue dollar bills in exchange for 50-cent pieces? Unfortunately, many corporate managers have been willing to do just that. The first choice of these managers in making acquisitions may be to use cash or debt, but frequently, the CEO's cravings outpace cash and credit resources. Certainly mine always have. Frequently also, these cravings occur when his own stock is selling far below intrinsic business value. This state of affairs produces a moment of truth. At that point, as Yogi Berra has said, you can observe a lot just by watching. For shareholders then will find which objective the management truly prefers, expansion of domain or maintenance of owner's wealth. The need to choose between these objectives occurs for some simple reasons. Companies often sell in the stock market below their intrinsic business value, but when a company wishes to sell out completely in a negotiated transaction, it inevitably wants to, and usually can, receive full business value in whatever kind of currency the value is to be delivered. If cash is to be used in payment, The seller's calculation of value received couldn't be easier. If stock of the buyer is to be the currency, the seller's calculation is still relatively easy. Just figure out the market value in cash of what is to be received in stock. Meanwhile, the buyer wishing to use his own stock as currency for the purchase has no problems if the stock is selling in the market at full intrinsic value. But suppose it is selling at only half intrinsic value. In that case, the buyer is faced with the unhappy prospect of using up substantially undervalued currency to make its purchase. Ironically, were the buyer to instead be a seller of its entire business, it too could negotiate for, and probably get, full intrinsic business value. But when the buyer makes a partial sale of itself, and that is what the issuance of shares to make an acquisition amounts to, it can customarily get no higher value set on its shares than the market chooses to grant it. The acquirer, who nevertheless barges ahead, ends up using an undervalued market value currency to pay for a fully valued, negotiated value property. In effect, the acquirer must give up $2 of value to receive $1 of value. Under such circumstances, a marvelous business purchased at a fair sales price becomes a terrible buy, for gold valued as gold cannot be purchased intelligently through the utilization of gold, or even silver, valued as lead. If, however, the thirst for size and action is strong enough, the acquirer's manager will find ample rationalizations for such a value-destroying issuance of stock. Friendly investment bankers will reassure him as to the soundness of his actions. Don't ask the barber when you need a haircut. A few favorite rationalizations employed by stock issuing managements follow. A. The company we're buying is going to be worth a lot more in the future. Presumably so is the interest in the old business that is being traded away. Future prospects are implicit in the business valuation process. If 2x is issued for x, the imbalance still exists when both parts double in business value. B. We have to grow. Who, it might be asked, is the we? For present shareholders, the reality is that all existing businesses shrink when shares are issued. Were Berkshire to issue shares tomorrow for an acquisition, Berkshire would own everything that it now owns plus the new business, but your interest in such hard-to-match businesses as See's Candy Shops, National Indemnity, etc., would automatically be reduced. If 1. Your family owns a 120-acre farm, and 2. You invite a neighbor with 60 acres of comparable land to merge his farm into an equal partnership with you to be managing partner, then 3. Your managerial domain will have grown to 180 acres, but you will have permanently shrunk by 25% your family's ownership interest in both acreage and crops. Managers who want to expand their domain at the expense of owners might better consider a career in government. C. Our stock is undervalued and we've minimized its use in this deal, but we need to give the selling shareholder 51% in stock and 49% in cash so that certain of those shareholders can get the tax-free exchange they want. This argument acknowledges that it is beneficial to the acquirer to hold down the issuance of shares, and we like that. But if it hurts old owners to utilize shares on a 100% basis, it very likely hurts on a 51% basis. After all, a man is not charmed if a spaniel defaces his lawn just because it's a spaniel and not a St. Bernard, and the wishes of sellers can't be determinant of the best interests of the buyer. What would happen if, heaven forbid, the seller insisted that as a condition of merger, the CEO of the acquirer be replaced? There are 3 ways to avoid destruction of value for old owners when shares are issued for acquisitions. 1 is to have a true business value for business value merger, such as the Berkshire Blue Chip combination is intended to be. Such a merger attempts to be fair to shareholders of both parties, with each receiving just as much as it gives in terms of intrinsic business value. The Dart Industries Kraft and Nabisco Standard Brands mergers appeared to be of this type, but they are the exceptions. It is not that acquirers wish to avoid such details, it's just that they are very hard to do. The second route presents itself when the acquirer's stock sells at or above intrinsic business value. In that situation, the use of stock as currency actually may enhance the wealth of the acquiring company's owners. Many mergers were accomplished on this basis in the 1965 to 69 period. The results were the converse of what most of the activity since 1970 The shareholders of the acquired company received very inflated currency, frequently pumped up by dubious accounting and promotional techniques, and were the losers of wealth during such transactions. During recent years, the second solution has been available to very few large companies. The exceptions have primarily been those companies in glamorous or promotional businesses to which the market temporarily attaches valuations at or above intrinsic business value. The third solution is for the acquirer to go ahead with the acquisition, but then subsequently repurchase a quantity of shares equal to the number issued in the merger. In this manner, what originally was a stock-for-stock merger can be converted effectively into a cash-for-stock acquisition. Repurchases of this kind are damage repair moves. Regular readers will correctly guess that we much prefer repurchases that directly enhance the wealth of owners instead of repurchases that merely repair previous damage. Scoring touchdowns is more exhilarating than recovering one's fumbles, but when a fumble has occurred, recovery is important, and we heartily recommend damage repair repurchases that turn a bad stock deal into a fair cash deal. The language utilized in mergers tends to confuse the issues and encourage irrational actions by managers. For example, dilution is usually carefully calculated on a pro forma basis for both book value and current earnings per share. Particular emphasis is given to the latter. When that calculation is negative, dilutive from the acquiring company's standpoint, a justifying explanation will be made, internally if not elsewhere, that the lines will cross favorably at some point in the future. While deals often fail in practice, they never fail in projections. If the CEO is visibly panting over a prospective acquisition, subordinates and consultants will supply the requisite projections to rationalize any price. Should the calculation produce numbers that are immediately positive, that is, anti-dilutive for the acquirer, no comment is thought to be necessary. The attention given this form of dilution is overdone. Current earnings per share, or even earnings per share of the next few years, are an important variable in most business valuations, but far from all-powerful. There have been plenty of mergers, non-dilutive in this limited sense, that were instantly value-destroying for the acquirer, and some mergers that have diluted current and near-term earnings per share have, in fact, been value-enhancing. What really counts is whether a merger is dilutive or anti-dilutive in terms of intrinsic business value, a judgment involving consideration of many variables. We believe calculation of dilution from this viewpoint to be all-important and too seldom made. A second language problem relates to the equation of exchange. If Company A announces that it will issue shares to merge with Company B, the process is customarily described as Company A to acquire Company B, or B sells to A. Clearer thinking about the matter would result if a more awkward but more accurate description were used. Part of A sold to acquire B, or owners of B to receive part of A in exchange for their properties. In a trade, what you are giving is just as important as what you are getting. This remains true even when the final tally on what is being given is delayed. Subsequent sales of common stock or convertible issues, either to complete the financing for a deal or to restore balance sheet strength, must be fully counted in evaluating the fundamental mathematics of the original acquisition. If corporate pregnancy is going to be the consequence of corporate mating, the time to face that fact is before the moment of ecstasy. Managers and directors might sharpen their thinking by asking themselves if they would sell 100% of their business on the same basis they are being asked to sell part of it. And if it isn't smart to sell all on such a basis, they should ask themselves why it is smart to sell a portion. Accumulation of small managerial stupidities will produce a major stupidity, not a major triumph. Las Vegas has been built upon the wealth transfers that occur when people engage in seemingly small, disadvantageous capital transactions. The giving versus getting factor can most easily be calculated in the case of registered investment companies. Assume investment company X, selling at 50% of asset value, wishes to merge with investment company Y. Assume also that company X therefore decides to issue shares equal to market value to 100% of Y's asset value. Such a share exchange would leave X trading $2 of its previous intrinsic value for $1 of Y's intrinsic value. Protests would promptly come forth from both X shareholders and the SEC, which rules on the fairness of registered investment companies' mergers. Such a transaction simply would not be allowed. In the case of manufacturing, service, financial companies, etc., values are not normally as precisely calculable as in the case of investment companies, but we have seen mergers in these industries that just as dramatically destroyed value for the owners of the acquiring company, as was the case in the hypothetical illustration above. This destruction could not happen if management and directors would assess the fairness of any transaction by using the same yardstick in the measurement of both businesses. Finally, a word should be said about the double whammy effect upon owners of the acquiring company when value-diluting stock issuances occur. Under such circumstances, the first blow is the loss of intrinsic business value that occurs through the merger itself. The second is the downward revision in market valuation that, quite rationally, is given to that now diluted business value. For current and prospective owners, understandably, will not pay as much for assets lodged in the hands of a management that has a record of wealth destruction through unintelligent share issuances as they will pay for assets entrusted to a management with precisely equal operating talents, but a known distaste for anti-owner actions. Once management shows itself insensitive to the interests of owners, shareholders will suffer a long time from the price-value ratio afforded their stock relative to other stocks. No matter what assurances management gives that value-diluting action taken was one-of-a-kind event, those assurances are treated by the market much as one bug-in-the-salad explanations are treated at restaurants. Such explanations, even when accompanied by a new waiter, do not eliminate a drop in the demand, and hence market value for salads, both on the part of the offended customer and his neighbors pondering what to order. Other things being equal, the highest stock market prices relative to intrinsic business value are given to companies whose managers have demonstrated their unwillingness to issue shares at any times on terms unfavorable to the owners of the business. I've mentioned that we strongly prefer to use cash rather than Berkshire stock in acquisitions. A study of the record will tell you why. If you aggregate all of our stock-only mergers, excluding those we did with two affiliated companies, Diversified Retailing and Blue Chip Stamps, you will find that our shareholders are slightly worse off than they would have been had I not done the transactions. Though it hurts me to say it, when I've issued stock, I've cost you money. Be clear about one thing. This cost has not occurred because we were misled in any way by sellers or because they thereafter failed to manage with diligence and skill. On the contrary, the sellers were completely candid when we were negotiating our deals and have been energetic and effective ever since. Instead, our problem has been that we own a truly marvelous collection of businesses, which means that trading away a portion of them for something new almost never makes sense. When we issue shares in a merger, we reduce your ownership in all of our businesses, partly owned companies such as Coca-Cola and American Express, and all of our terrific operating companies as well. An example from sports will illustrate the difficulty we face. For a baseball team, acquiring a player who can be expected to bat .350 is almost always a wonderful event, except when the team must trade a .380 hitter to make the deal. Because our roster is filled with .380 hitters, we have tried to pay cash for acquisitions, and here our record has been far better. Starting with National Indemnity in 1967 and continuing with, among others, Seas, Buffalo News, Scott Fetzer, and Geico, we have acquired, for cash, a large number of businesses that have performed incredibly well since we bought them. These acquisitions have delivered Berkshire tremendous value. Indeed, far more than I anticipated when we made our purchases. We believe that it is almost impossible for us to trade up from our present businesses and managements. Our situation is the opposite of Camelot's Mordred, of whom Guinevere commented, "The one thing I can say for him is that he is bound to marry well. Everybody is above him. Marrying well is extremely difficult for Berkshire." In contemplating business mergers and acquisitions, many managers tend to focus on whether the transaction is immediately dilutive or anti-dilutive to earnings per share, or, at financial institutions, to per share book value. An emphasis of this sort carries great dangers. Imagine that a 25-year-old first-year MBA student is considering merging his future economic interests with those of a 25-year-old day laborer. The MBA student, a non-earner, would find that a share-for-share merger of his equity interest in himself with that of the day laborer would enhance his near-term earnings in a big way. But what could be sillier for the student than a deal of this kind? In corporate transactions, it's equally silly for the would-be purchaser to focus on current earnings when the prospective acquiree has either different prospects, a different mix of operating and non-operating assets, or a different capital structure. At Berkshire, we have rejected many mergers and purchase opportunities that would have boosted current and near-term earnings, but that would have reduced per-share intrinsic value. Our approach, rather, has been to follow Wayne Gretzky's advice: go to where the puck is going to be, not where it is. As a result, our shareholders are now many billions of dollars richer than they would have been if we had used the standard catechism. The sad fact is that most major acquisitions display an egregious imbalance. They are a bonanza for the shareholders of the acquiree. They increase the income and status of the acquirer's management, and they are a honeypot for the investment bankers and other professionals on both sides. But alas, they usually reduce the wealth of the acquirer's shareholders, often to a substantial extent. That happens because the acquirer typically gives up more intrinsic value than it receives. Do that enough, says John Medlin, the retired head of Wachovia Corp., and you are running a chain letter in reverse. Over time, the skill with which a company's managers allocate capital has an enormous impact on the enterprise's value. Almost by definition, a really good business generates far more money, at least after its early years, than it can use internally. The company could, of course, distribute the money to shareholders by way of dividends or share repurchases, but often the CEO asks a strategic planning staff, consultants, or investment bankers whether an acquisition or two might make sense. That's like asking your interior decorator whether you need a $50,000 rug. The acquisition problem is often compounded by a biological bias. Many CEOs attain their positions in part because they possess an abundance of animal spirits and ego. If an executive is heavily endowed with these qualities, which, it should be acknowledged, sometimes have their advantages, they won't disappear when he reaches the top. When such a CEO is encouraged by his advisors to make deals, he responds much as would a teenage boy who is encouraged by his father to have a normal sex life. It's not a push he needs. Some years back, a CEO friend of mine, in jest it must be said, unintentionally described the pathology of many big deals. His friend, who ran a property casualty insurer, was explaining to his directors why he wanted to acquire a certain life insurance company. After droning rather unpersuasively through the economics and strategic rationale for the acquisition, he abruptly abandoned the script. With an impish look, he said, "Ah, fellas, all the other kids have one." At Berkshire, our managers will continue to earn extraordinary returns for what appears to be ordinary businesses. As a first step, these managers will look for ways to deploy their earnings advantageously in their businesses. What's left, they will send to Charlie and me. We then will try to use those funds in ways that build per-share intrinsic value. Our goal will be to acquire either part or all of businesses that we believe we understand, that have good, sustainable underlying economics, and that are run by managers whom we like, admire, and trust.